thank you for letting the audience know that we are the panel standing between them and drinks, but bear with us. So thank you very much for sticking it out for the full day. My name is Sherry Major. I'm a partner at KPMG. I'm in our deal advisory practice, and I help clients through M&A and capital markets transactions. But I also lead our capital markets readiness practice, so helping companies get ready for the IPO process and becoming newly public companies. So what we're going to touch on in this panel is that transition from being PE-backed, PE-owned, to entering the capital markets. And as you'll hear in a moment from this great panel, I think we've got the largest panel of anybody at the conference. I think that's a good sign. You're going to hear there's quite a variety of experience on the panel because there are so many areas that are impacting management teams and companies as they consider that transition. And so you'll hear a number of sort of things to be on the lookout for, and I will certainly open it up for questions right before we wrap. So if we could start with John. Intro.
Hello, how are you? Thank you for sticking in, especially for an insurance-related discussion. My name is John Marchese. I lead Arthur J. Gallagher's public offering practice. It's related to SPAC IPOs, regular way IPOs, and then M&A transactions. The work that I do crosses over a couple of different disciplines and practices. So Gallagher as an organization is broken up into niche-focused practice groups, both in industry and then coverage line verticals. So my specific industry is private equity financial institutions dealing with a coverage line of public D&O and transactional liability.
Hi everyone. I'm Jim Palmater, CEO and co-founder of Dragon GC. I've helped numerous companies over the course of my career, 25, 30 years in corporate governance and compliance. I founded a company back in 2013, Summit Financial Disclosure, and sold it 4.5 years later to Broadridge, a 6x plus return for investors. And so I'm happy to be doing it all over again here today and supporting this organization because I've gone further upstream. So we built a wonderful company helping companies with their Qs and Ks, their filings, capital markets transactions, as you described, M&A and IPOs. And I've been involved personally with over 400 IPOs in my career. But here with Dragon, not to make it an infomercial, but what we're doing today is helping companies with their disclosure, and it's specifically around the content that they're sharing. So we recently did a report, and I think everybody would like to know this. Shareholder communication has grown so much over the last 20 years, and there's going to be a report coming out soon with our data saying how much it's really grown in, so many disclosure topics where you need to be mindful of today. That's so different than it was 20 years ago, and it's ever changing. And so we have a SaaS platform to help address that. But I'm happy to be here, and I know the questions are going to come rolling in.
Thank you. Mark.
Hi, my name is Mark Meltz. I was early in my career trained as a lawyer, worked at a major law firm in a corporate department, transitioned actually to life sciences industry for a variety of companies in a number of different therapeutic areas. In the last 10 years or so, I've been in C-suite for both private and public companies, including VC-backed, private equity-backed companies, and in that 10-year period have been on the sell side of 3 exit M&A transactions, and I'm currently, and that's both for private and public companies, and currently providing some advisory services to some companies as they endure, I use the word endure, post-acquisition sort of challenges of what did I just buy? I know I spent this money, what did I just buy? How do I clean it up, run it more efficiently?
Hi, I'm Chuck Garsk. I'm with Okapi Partners, Senior Managing Director. Okapi is a proxy solicitation investor response firm and stock surveillance firm.
That's quick. Hi, I'm Tad Natchev. I'm in the capital markets group at the New York Stock Exchange. I'm specifically responsible for our relationships with the private equity community. I've been at the exchange for a little over 3 years now. Prior to coming to the exchange, I was an institutional salesperson in New York City, mostly large, long only, sovereign wealth funds, et cetera. Half my career was at Goldman and Lehman. And I like to say I've sold more IPOs than everyone at the NASDAQ and the NYC put together.
How's that for claim to fame? Well, Tad, I will start with you. I thought it would be helpful to set the stage for What has 2024 been like for PE-backed IPOs, and what do you see on the horizon for 2025?
Got it. Okay, so in terms of 2024, there's about 8 billion in private equity-backed IPOs so far in terms of capital raised. We always at our exchange talk about capital raised. There's another exchange that actually talks about number of transactions because they do a lot of little tiny transactions that do not qualify. But it's been 8 billion this year. It's 3.5 billion next year. You know, if you listen to what one of the prior panelists talked about, the big rat going through the snake, in terms of distributions being needed to be made, I think you'd expect next year to be another double or maybe triple. You know, we, in terms of our internal pitch activity, we're very busy.
Excellent. I take that as good news.
Should be.
Mark, I'm going to come to you next. You've had quite varied experience, and you've been, you know, both early on in the sort of PE acquisition life cycle, lived through operating under PE and then selling. And so I'd love your perspective on what is different in terms of executing operationally, when you're a private company versus public, and then what are some of the, you know, challenges around meeting goals or maybe missing goals?
Sure. Well, I'd say in the first instance, whether you're working for a private or a public company, if you're part of the management team, you want to set smart, realistic goals, and you want to work closely with your teams to achieve them. In my experience, whether you're in a private company or a public company, either of those, your sort of audience for that could be relenting in their reaction or embracing in their reaction, right? And so if you think about it from a private company perspective, you might say on one hand, because it is more opaque, and what I mean by that is there's no public reporting requirement. You establish some goals, you missed your goal. So, but how did you miss it? Well, there's not a quarterly earnings announcement. There's updates that you give to your board. And you might say, well, that's okay, because we're in the private setting, it's just sort of among us that we share that information. There's no outward market reaction to that. And that's sort of true, but at the same time, in the private context, in my experience, more closely held. So say you're PE backed, right? You have an audience that's very discreet, but they're also super sophisticated. And so they can be relenting, right? Maybe there's a first pass, there might not be a second pass. Now flip that to the public company. It's a more diffuse equity held by many more shareholders, not all of whom are as sophisticated as your private equity backed, but you have an obligation to disclose to them material information, do that in a timely way under Reg FD and related requirements. And so when that happens, you don't necessarily have time to make it up because the market is going to react. And your price will either go up, which is great if you have great results or exceed those results, or your price is going to go down. And I'll use the life sciences experience because this happens all the time. You come out with clinical trial results, and if the market doesn't really embrace them in a way, your stock was like that, and then it kind of goes down, and you don't have really that opportunity to say, hey, oh, but wait, here's the explanation. In the private setting, with adults in the room who are supportive, both because they own your equity and they're on your board, you can explain what happened, give a logical explanation to why you missed the mark, and tell them how you're going to improve things. You sort of get that opportunity in the public market, but not as cleanly and calmly as you want to be able to do it. Your relationships just are not as close as they are in the private market.
Yeah, absolutely. And you touch on a really good point where you say, you know, you might get a pass in the private markets. That's one of the things I, advise my clients is when they're preparing for the IPO process is they want to have a couple of quarters of dry running, earnings and meeting the goals and disclosing, how you would portray that to the street, because you don't want to do that for the first time in the public markets, and you certainly don't want to fail when it's your first time.
No, and I'd stress that last point, right? And it's kind of runs counter to what's driven you in your career at that point. Say you're the CEO or CFO of a public company, newly minted public company. You want the market to be excited. So you got to kind of be guarded in what you say, because if you set those lofty ambition here and you come in here, it's going to be relentless, right, in the market reaction to it. If you set it here and come in here, you're going to like that result like that.
Yeah, absolutely. Thank you. John, I'm going to come to you. So maybe share a little bit about how you work with PE sponsors and what are some of the considerations for a portfolio company that's preparing to go public around risk and insurance, your area of expertise?
So, bifurcated answer, I guess. meaning that how Gallagher works more broadly across the enterprise with private equity companies that are looking to off-ramp assets publicly versus what I do. So as I mentioned, we have niche focused practice groups. So me specifically talking to financial lines, D&O, transactional liability in the context of a public offering, I'm doing, or I should say, a large part of my job, if it's done correctly, is making demonstrable all of the efforts that yourself and readiness colleagues are making behind the scenes on the pathway to the public markets. There's a lot of propaganda in the insurance broking industry where brokers will say, as if this generates the best results or the most optimum results, that they've gone to 55 markets with your submission. And there's a cloak there, they say, oh, we've gone to 55 markets. And I'll tell you that it costs on average, the last number that I've seen, $1,600 for an insurer to just simply set up a file for a submission. So you have to think about just simply the human element of that, to think that there's one insurer that's going to win that business. So you've just effectively burned 54 people, right? So how long before you start firing submissions every time you get one to these insurers where they no longer take you seriously? And you know right there that does just not generate good results. At any given time, I would say there's 3 to 5 insurers in the U.S. that have true sustainable D&O, public D&O, with 3-year 33 Act exposure to federal securities laws in an IPO transaction. So you take it from there. I would make it akin to what you see in staging a home. You know, you're not there to cover up a crack in the foundation, but what you are there is to paint a picture of what this risk is going to look like. All of the efforts that we were saying about readiness. The SPAC market is a great example of how this is illustrated. I wrote the underwriting model for the lead D&O insurers for the SPAC market back in 2018, and the simple premise was that private equity-backed assets have proven to perform demonstrably better just from the maturization level that they had. They have access to audit-ready financials. They have access to professional operating talent. They have sophisticated PR and IR apparatus, all that was proven to be sustainable. The data's there. It's a material delta in the early stage companies, right? So you're trying to paint a picture for the underwriter to say, this is a true partnership. We're not here to commoditize this and have you collect premium on year one. Any underwriter that thinks that they only have 1 year to write your company is obviously going to charge you as much as they possibly can. But when you get them bought into the story, which is where really the work is done, it's like a fighter preparing, right? All the work is done in the gym before you take it to market. That's the key.
Great, thank you. Chuck, I'm going to come to you next. So certainly D&O insurance, one element of what companies are dealing with, right, as they transition. What are some of the other areas that you've advised your clients on and that you help them when it comes to that transition from PE to capital markets?
So typically, Okapi will be brought in after the company goes public, and we help companies identify who their holders are, how they think and behave, and then advise them, say, we go back and the most important thing is first, look at the board. Make sure it's a diverse board. Make sure that there's gender diversity on there. There's all kinds of voting policies from all the big institutions, the proxy advisory firms, ISS, Glass Lewis, all want that representation. And if you don't have it, they'll start to recommend a vote against the nom-gov committee chair. And then there's some institutions such as like State Street that are looking at 30% gender diversity. And you know, the thing here is that it doesn't sound like, oh, it's not a big deal if they vote against, but it's not the company, it's the board member that they're targeting. And then if they have multiple board seats and different public companies, they're going to start to get concerned and they're going to start to say, listen, we need to do something here because this is really my career. And so that's the first, I think, piece that we would look at. And the second is the governance of the company, whether or not they have a classified board or super voting majority provisions. These are all problematic governance features for the proxy advisory firms and for some of the top institutional investors. And unless they have sunset provisions, coming out of the IPO, ISS will go after and recommend against the full board. And to the same point, it's after a while, and after PE unwinds their position, it's going to be pretty impactful, and then you're going to have to deal with it, for years to come. And until you actually remove those features, ISS will recommend and Glasshouse recommend every year until that. So it is pretty important. And then I think the other piece too is utilizing stock surveillance and knowing who your holders are on a weekly, monthly basis, who's trading in, who's trading out. And I think it's important because if you have a CFO that's a new CFO to being a public company and he doesn't have or she doesn't have a lot of experience, they're not going to have those relationships with those investors, and so they have to rely on some advisor, and a good stock surveillance could help transition that piece to the CFO by providing all that data, setting up meetings, and keeping them not relying on just quarterly filings of who owns your shares. So
Yeah, a couple of things that I want to react to that you were talking about. So certainly from a board perspective, you really pinpointed like the challenge of having that diverse board. And one thing I would say is that's something that actually needs to start before the IPO. There's certainly a year of sort of ramp time to get to a majority independent boards and get the right diversity and right qualifications. But it's so challenging, I think, these days to find the right board members that don't underestimate how much time that takes. And it's a process that really should be started before the IPO.
We're all over that.
Yeah.
Okay, so one of the things I do with sponsors, my initial call is usually with the head of capital markets, and we talk about something that's called the board advisory services at the NYSE. Board advisory services now has 900 vetted diverse candidates that have all been vetted by at least one New York Stock Exchange CEO. By vetted, it's not just a one-liner in there. And there's a process to get on the boards and things like that. But we've, in the last year, placed 50 people on boards. I'll work with sponsors and their portfolio companies to help build that out as they're getting closer and closer to an exit. I contrast that to our competitor who basically says, this is what diversity looks like, and you need to report to us that you have at least one underrepresented person on the board. Now, you've already got Chuck and his guys doing that. To us, that's redundant, and we're an exchange. So I like to say we offer tools, not rules, and it really is something that companies take us up on, and we charge nothing for this. It's something that we do as part of our business development. If you were to go to NASDAQ and they say, we don't like the way your board looks, it's not diverse enough, and you say that we'd like some help with a search, they'll say, great, it's $200,000.
Yep, great, good segue, thank you. Jim, I certainly want to come to you. I don't want to miss out on anybody before we open it up to questions. I love your numbers of over 200 IPO transactions. I used to think my number was good at around 60, 70, but you've more than got me beat.
Well, I've got a few years on you, as I'm reminded.
That wasn't the point of why I said that, but thank you. Maybe share some of the lessons you've learned from raising capital from accredited investors and PE firms that would be helpful to the audience.
Yeah, I'd be happy to share that. So it's in line with some that has already been said. I'll start off because I've built a company, ground up, ground zero. I'd say, build an A-player management and operating team. So this is when you're preparing your business plan for, accredited investors. And they are going to want to know, you've thought about everything that goes into your P&L. Know your competition. Do a peer group analysis. How do you differentiate yourself from the competitors? And again, back to Mark's, don't overpromise on your growth projections.
Please, thank you.
Yeah. And communicate. So these investors, when you give them the respect that they deserve, they're putting up their hard-earned money into your company and helping you build your dream. Give them the courtesy of quarterly or at least biannually updates, and those updates should be thorough and complete, and offer an investor call-in. Pretend start acting like you are a publicly traded company already, and you deserve that kind of respect. And I will tell you that from doing that, and be also prepared to pivot on your original go-to-market strategy. So, the best laid plans, and even with all of your years of experience, that go-to-market strategy, we all have witnessed. Pandemic, inflationary pressures, supply chain, all of these things may not have been thought about 5 years ago, but they're ever changing. Cybersecurity threats, whatever, it's going to come at you fast and hard, and be prepared and not afraid to address those challenges. But when you do, and you are successful, as fortunately I was in my last go around, very successful, 4.5 years, a 6.6x return for investors, they will support you on your next go around. And so I'm proud to say that they were all in on the Dragon GC AI platform for legal intelligence, for corporate governance and compliance. So thank you.
Excellent. Thank you very much. So we've been able to give you a taste of what each of these panelists has learned sort of throughout their careers and what tips and tricks they have for you. I certainly won't have the time to go down the row again and ask everyone to speak on a specific topic. So I think this is a great time to open it up to all of you to get the chance to ask what burning questions are on your mind. And if you ask a question, John will buy you a drink at the cocktail reception. Yeah.
Well, first of all, I'll say the window has been open, okay? About 37 billion in proceeds has been raised so far this year. That's the pace we're on. A normal year is 50 to 55. 2020 and 2021 were 150 to 160 billion in proceeds raised. Okay, so I know Chris knows that, and it's something where that just gets the mind, like that's the window. But no, we're getting a normal level, and what's different now, I think this year and some of last year, is that the transactions are larger. The transactions are larger, I think, for a couple of reasons. First of all, that's how kind of things do start to broaden out. If you think about the stock market in general, it's been a very narrow market over the last few years, right? It's the old Mag 7, but at some point in time, NVIDIA can't triple again, right? So it does start to broaden out, and you're starting to see some of that. But if you're a public investor, the folks that I used to do business with, and I talk to them all the time, when you talk about, them trying to beat a narrow market, the only way they can do that is to concentrate positions. You're not going to concentrate your position unless it's something that's big and liquid. So it makes sense from those two standpoints that those are the things that have come out first.
Question over here? Yeah, absolutely. So in case you didn't hear, I think the punchline was it is roughly a 2-year process to get ready to go from being private to public. And you're singing my tune. I say the exact same thing. And I think what we saw in this back boom is that the timelines were much faster and more accelerated, and what happened is some companies had been on a path to getting ready to go public even before they entered into a SPAC merger transaction, so they were fine. But then this acceleration started, and companies who had never even considered going public started to be approached. And so what happened is they did what they needed to do to execute the transaction, but hadn't yet done what was needed to actually be a good, sustainable public company. And then they were doing that while they were public, which I don't think any of us would ever advise. And so that was the challenge, one of the challenges of that time frame. So you are totally right. If you can take those 2 years, every company's at a different stage of maturity, and there are things that you can do along that 2-year journey that are going to be what I call no regrets work, and will just help companies be better, more mature companies, regardless of whether a transaction occurs or not. So take advantage of time, because time is your friend.
Well, Sherry, and I'd add as well, to put an expression of support for professionals like KPMG, the auditing firms are a great resource because it's an internal check. I consider that internal because they're working together. They will advise you quietly to you about whether they think you're ready or not, and if not, what you need to. You don't want to get sort of material weakness so they don't want to say that publicly. You don't want to have to disclose that publicly, right? You want to prepare for it so that you are ready to do it, and then you bankers through the process as well. That you assemble a dream team of folks who are coordinating together, and they will give you candid input about whether or not you're ready, and if not, what you need to do, how you can improve to be ready.
Question in the back? wants to go? Nobody's jumping on that one.
Yeah, that's,
I'll take it from a couple different things. So I'm former NYSE. I was down NYSE for 16 years as a specialist and exchange official, which is where I cut my teeth in the SPAC market, 2004 to 2010. So I appreciate what you mentioned. I would take it just say for the SPAC, for example, right? You have to remember that the SPAC is an instrument. It's to travel, or a vehicle to travel an alternative pathway to the capital markets. The earlier iterations were scuttled by long short vote arbitrage, which ruined the vehicle. When they decided to fix that and remedy that by decoupling the vote and the redemption right, you created now a need to recirculate capital at the time of the closing. So now you have absolute event-driven investors up front, which makes complete and total sense because it's a yield play. You're getting a cushion bond rate of return with the optionality of the warrants and a free shot at the combined entity and really a look in the answers to the test. But all that to say is that you have to take that interest rate environment into consideration and remember that capital is what the SPAC breathes on, right? So when you can get that sort of return or opportunistically in the regular market in the S&P, that puts a little bit of a damper on that. I'll let someone else take the other side. If that makes sense.
You know, you're mentioning the macro, right? And that macro battle is kind of against what Brad was quoting earlier about that big rat in the snake. That being said, you know, a private equity sponsor's favorite exit is not an IPO. It's a strategic sale. I'll give you one example. 6 years ago, Leonard Green from LA bought a company called SRS from another private equity firm for $3 billion. They just sold it this year, 6 years later, for $18 billion to Home Depot. Done, right? Do they want to hang out for another 6 or 7 years and try and get another billion? Probably not. That being said, at some point in time, there are businesses that are going to be a better fit for the public market than going to a strategic. In the areas of software technology, there's probably only about 20 strategics left that can actually do something. That comes from the bigger software investors out there. So there's fewer than 100 private equity firms that have done more than one IPO in the last 15 years. There's 9,000 private equity firms in the world. So yeah, you're still going to have private markets and public markets, and they're going to coexist. Some will go in and out. KKR just closed on Instructure today. It's the second time it's been taken private. You know, these are mechanisms.
Great, thank you. Thank you everyone for the questions. Thank you to our panelists, really appreciate it.